On September 15, 2008, the fourth largest investment bank in America filed for bankruptcy, and nobody saw it coming, even though the warning signs were everywhere. That morning, Lehman Brothers executives walked into their Midtown Manhattan headquarters knowing it was over. The firm had $619 billion in assets. By lunchtime, it was gone, not sold, not rescued, liquidated. The decision to let Lehman fail, made by Treasury Secretary Henry Paulson and Federal Reserve Chairman Ben Bernanke just hours earlier, would trigger the worst financial crisis since the Great Depression. But this wasn't a sudden collapse. It was the inevitable end of a 164-year-old institution that had made a series of calculated, rational decisions under impossible pressure. Let's rewind to 2003. The housing market was booming, interest rates were low, banks were lending money to anyone with a pulse and some without. Lehman Brothers, founded in 1844 as a cotton trader, had reinvented itself as a powerhouse of modern finance. Its CEO, Richard Fuld, was a trader's trader. He'd steered the firm through the 1998 Russian debt crisis and the 2001 dot-com collapse. Fuld believed Lehman could outrun any storm. In 2003, Lehman made a fateful bet. It acquired a mortgage lender called BNC Mortgage. The logic was simple: housing prices always go up. If you control the mortgage pipeline, you control the profits. Lehman poured money into subprime mortgages, loans to borrowers with poor credit, given at adjustable rates. When the rates reset, these borrowers would default. Everyone knew this. The bet was that housing prices would rise fast enough to cover the losses. By 2006, Lehman had amassed $85 billion in mortgage-related assets. That's not a typo, $85 billion. The firm was so confident that it used leverage, borrowed money to magnify returns. For every dollar of capital, Lehman borrowed $30. This meant tiny losses got amplified into catastrophic ones. Fuld knew the leverage was extreme. He also knew that every other major bank was doing the same thing. Stepping back meant losing market share and shareholder value, so he pressed forward. Then in 2006, housing prices stopped climbing. By 2007, they began to fall. Subprime borrowers started defaulting en masse. The mortgages Lehman had packaged into securities sold to pension funds, insurance companies, and foreign banks became worthless overnight. But Lehman didn't immediately collapse. Why? Because the broader financial system was still functioning. Credit was still flowing. Banks still trusted each other. That trust evaporated in March 2008. Bear Stearns, another investment bank, nearly went under. The Fed orchestrated a rescue. JP Morgan bought it for $236 million, a fraction of its former value. The message to Wall Street was clear: we'll save you once, don't count on it again. Lehman's stock price plummeted, investors fled, credit markets froze. Lehman needed a lifeline. Fuld tried to sell. He approached Bank of America, Barclays, and others. Each deal fell apart. The assets were too toxic, the losses too large. By September 2008, Lehman had burned through $4 billion in capital in a single quarter. The firm had maybe days of liquidity left. On the evening of September 12th, Paulson and Bernanke made their choice: no government rescue. Lehman would fail. The decision was rational given what they knew. They believed the financial system could absorb the shock. They were catastrophically wrong. The collapse of a $619 billion institution sent shockwaves through every corner of global finance. Money market funds broke, credit froze completely, banks stopped lending to each other. Within weeks, credit card companies, auto manufacturers, and retailers faced collapse. The unemployment rate spiked to 10%, home foreclosures accelerated. The U.S. government ultimately spent $700 billion on emergency bailouts. Lehman's bankruptcy filing was the largest in American history. What happened to Lehman wasn't fraud. It wasn't a secret scheme. It was a series of decisions made by intelligent people operating within the rules, each choice seeming rational in isolation. Buy mortgages, smart. Use leverage, everyone else does. Hold them to maturity, prices will recover. Every assumption was reasonable. Every decision was defensible. Yet together they created a powder keg. The deeper lesson is about systems. When every major financial institution makes the same bet and that bet is wrong, there's no margin for error. When leverage is extreme across the entire industry, a small decline becomes a catastrophe. When trust is the only thing holding the system together and trust evaporates, there's nothing left. Lehman didn't fail because it was uniquely reckless. It failed because it was perfectly normal. Today, Lehman Brothers is a cautionary tale, but the wrong one. Most people blame greed or negligence. The real story is subtler and more dangerous. It's about how rational actors, each optimizing locally, can collectively create irrational outcomes. It's about how systems can be stable until they're not. And it's about how the decisions you make under pressure, with the information you have at the time, can echo across the entire world. If you want to understand how power structures collapse from their own logic, hit subscribe. We're breaking down the next one next week.